Good afternoon, and welcome to today's event, the 14th of the Federal Housing Finance Agency's Federal Home Loan Bank System at 100, focusing on the future roundtable. Though this is the 14th, it is by no means the least important. Those of you who are FHFA junkies will know that climate change is a priority in the strategic plan for the agency, and today's event will focus on the Federal Home Loan Bank's role or potential role in supporting climate resiliency. To that end, we'll cover the phases of the disaster cycle from mitigation to preparedness to response to recovery. We'll also focus on the risk management practices and principles and discuss measures that have been taken and will need to be made to increase consumer awareness and consumer protection. As always, this event is also being live streamed so we can reach as many stakeholders as possible. We look forward to today's discussion and the feedback we receive. We've got a distinguished panel, and beside me is Karen Burke, who is a senior examiner.
Associate Director.
Associate Director, excuse me, at FHFA in the Division of Federal Home Loan Bank Regulation. And I'll turn it over to Karen, who will review the rules of engagement.
Great. Thanks, Chris, and thank you all for being here. We expect and hope that we will have an open and engaging discussion today among all of us. No recommendation or view should be construed off the table, and we encourage you to offer differing views about some important questions that we will be covering this afternoon. We also want this to be orderly. As such, we first ask that everyone turn their name placard to the side when you want to respond to a question, and we'll call on you. We ask that everyone engage in a respectful manner, knowing that we may not agree on all points. To ensure that everyone has a turn to speak and that we cover every discussion topic, if someone is going long, we may interject to keep the conversation going. Second, this review is meant to bring forward the views and reasoned perspectives of the Federal Home Loan Bank System stakeholders and highlight areas for further consideration. We ask that you not limit your responses to what you think would be possible under the current conditions or the current framework of the system. Third, that we'll have a break roughly halfway through the event. And finally, for the benefit of those in the audience, the roundtable participants have been given a set of prompts that we will reinforce during the course of this afternoon's discussion. And we have a disclaimer that I need to read verbatim, so I'll do that now. So we have organized this roundtable to obtain your input on the mission of the Federal Home Loan Banks, including input on several specific questions that were sent to you prior to the meeting. During today's discussion, FHFA will not discuss the status or timing of any potential rulemaking. If FHFA does decide to engage in a rulemaking on any matters discussed today, this meeting would not take the place of a public comment process. The rulemaking document would establish the public comment process, and you would need to submit your comments, if any, in accordance with the submission instructions in that document. FHFA may summarize the feedback gathered at today's session in future rulemaking documents if we determine that a summary would be useful to explain the basis of a rulemaking. Anything said in this meeting, and that also includes reactions, nodding, eye-rolling, should not be construed as binding on or a final decision by the director or the director of FHFA or FHFA staff. Any questions we may have are focused on understanding your views and do not indicate a policy or legal position. Participants in today's roundtable may have a financial interest, whether direct or indirect, on outcomes that may affect the Federal Home Loan Banks and their businesses. As Chris mentioned, today's roundtable will be live streamed on FHFA's website and video recorded. FHFA may also prepare a transcript of today's session, which would include the names of all speakers and the organizations they represent. The recordings and any transcripts prepared will be posted on FHFA's website and YouTube channel, along with any materials being presented today or otherwise submitted in conjunction with this roundtable. So with that, I'll turn back to you.
Thanks, Karen, and we all love our lawyers, don't we? It's a very, very comprehensive discussion. So before we get started, we'll do some introductions. Most of us had a chance to meet a little bit beforehand, but for the folks particularly watching the live stream, I'll ask you all to take turns introducing yourselves and who you're representing, any involvement you have with the home loan banks, if any, and then how your work touches on the topic that we're going to be discussing today. So let's start with Steve and work our way around.
Sure. Thank you very much for hosting this and for the invitation. Stephen Rothstein, I'm the Managing Director of the Ceres Accelerator. Ceres is an advocacy group focused on sustainability issues. We have no business relationships with Federal Home Loan Bank, but we've submitted lots of comments to FHFA and other agencies.
Hi, thank you so much for organizing this event and having me here today. I'm Caroline Nagy. I'm a senior policy counsel at Americans for Financial Reform, focused on housing, climate, and corporate control of housing. Americans for Financial Reform Education Fund is a nonprofit that fights to eliminate equality and systemic racism in the financial system in service of a just and sustainable economy. And we also do not have business before the federal home loan banks, but do have lots of opinions.
Perfect.
Hi, I'm David Beck. I'm the policy director at Self-Help. We're a community development financial institution headquartered in Durham, North Carolina, and operate nationwide. Our mission is to provide access to credit to low-income communities and individuals, particularly minority families, rural families, and female-headed households. And we are a 3-time member of the Federal Home Loan Bank through Self-Help Credit Union, Self-Help Federal Credit Union, and Self-Help Ventures Fund, which is our nonprofit, non-depository CDFI loan fund.
Hi, everyone. I'm happy to be here. My name is Miyuki Hino. I'm an assistant professor at the University of North Carolina at Chapel Hill in the Department of City and Regional Planning. My research addresses the impacts of climate change on social and economic outcomes, particularly housing markets, as well as other aspects, including migration. I also study public policy and the role that it can play in supporting more resilient and more effective adaptation moving forward in communities, for instance, through land use planning and disaster recovery policies that serve more equitable outcomes.
Good afternoon. I'm Richard Moore. I'm sorry I didn't get a chance to say hello to anybody at lunch. I'm the CEO of First Bancorp. We are just under a $13 billion institution, primarily in North Carolina, but we have a pretty decent market share in large portions of South Carolina. We're about a 90-year-old bank that does a little bit of everything, and one of those things is we are one of the owners of the Federal Home Loan Bank Board. A member/owner, whichever term you want to use.
Thanks, Karen.
All right. So as we said earlier, today's discussion is not a scientific discussion on the underlying causes of climate change, but instead we will focus on the Federal Home Loan Bank's role or potential role supporting the climate resiliency phases and also risk management. So let's do a quick round robin to set the table for this discussion and lay out potential discussion topics. We have a few in mind, but we also want to hear your ideas. So, climate, what you would like to discuss about the various aspects and implications of climate-related and natural disasters. This could be the physical risks mitigation. It could also be transition risks or other challenges and risks that you have thought of. And at this point, we're not asking to get into what the roles could be for the banks, but more of just getting the topics on the table. So start with Richard.
Which just saw off a piece of that, or what?
Yeah, just what do you think would be useful topics to talk about here? So I'll name one to get us started. So resilient building, right? Does it be an aspect of climate resiliency? But also just wanting to know what other topics you all would think would be worthy of discussion today. Stephen.
So I don't want to take, if you...
No, please go ahead.
So I think climate affects every element of the business. Kind of, if you think about what element would inflation or something else. So I think there's both physical and transition risk, and every element of the process, from the education of the consumer to the process flow to mitigation to remediation, and then the relationship, obviously, from the Federal Home Loan Banks to FHFA, and then the consumer element. And as several of our folks said earlier, all of this more directly impacts low wealth communities, so targeted what are particular needs for low wealth families.
Yeah, I'll go. I think a lot of what has already been said, but particularly within the context of the FHLB's, at 100, re-examining the mission, looking at how this system can be used to leverage more financing for getting communities ready to deal with climate change, assisting folks who have been impacted by natural disasters, and thinking bigger about what housing is going to look like when when there are increasing amounts of land that are not ideal for building housing on.
Yeah, I was just going to say resilience, just looking at the question, certainly incenting more resilient housing, but also remediation. How do we deal with, like we were talking at lunch about flood insurance and making sure that it reaches more people and more people are covered, and not just flood, but natural disaster. I mean, one of the things I'm always shocked about after these tornadoes and such in the news is if you own your home outright, odds are you do not have insurance on your home because the bank, really demands that. And if you don't have a bank, then so how do we? And that's a real issue in climate. So is there something the banks can do about that?
Great.
I would just add two things. One is discussing education and access and affordability of options that residents in risky places have to both transfer risk through insurance and to reduce their own risk, because I think insurance can only do so much. And then more broadly, looking at considering how climate change might affect inequality within and across communities, not just through housing channels, but also through other economic channels as well.
Well, there's no getting around the fact that climate change is affecting everything, everywhere. Steve, as you just said, we need more housing. It needs to be built in the right place. It needs to be more resilient. And how all that rolls into being affordable is going to be incredibly difficult. I'm not quite sure what direct role, or perhaps I'm not even clear about an indirect role that the Federal Home Loan Bank Board has to do with this topic, but I look forward to learning.
Great. Well,
Just another question to think
Yes.
about is what should be done at one of the 11 bank levels versus at a national level? There are a variety of issues there.
yes. All right, so I appreciate hearing those thoughts, and I think our questions, our prepared questions cover the lion's share of this, and will certainly provide opportunity to discuss all of this. So how we have it organized, the discussion's kind of organized around resilient building, disaster recovery efforts, risk management and trade-offs, consumer awareness, consumer protections, and then transition risks. It's kind of how we have it organized, just to give you a heads up on that. So we'll go ahead and start with a deeper dive into preparedness and mitigation, resilient buildings. And some of these questions starting off are broad, but what do communities need to create and support a strong supply of sustainable, affordable, and resilient housing? It's very, very broad.
So H.L. Mencken once said, for every complex problem, there's a simple answer that's always wrong. So I don't want to say there's one answer, but a piece of it would be is more information, that there is an asymmetry now of information. If you're a homeowner or a renter, or even if you're a developer of a reasonable size and an agency. So there needs to be more information at the time of closing, at the FHFA level, at the Federal Home Loan Bank, at the developer level, so people understand what is their risk, either as a renter, developer, financier, owner, and then to look at and understanding what the solutions are. That's a bucket of work, but more information needs to be there, just as there is at the time of closing.
Caroline?
I'm going to also give a one-word answer. In addition to information, we need money, particularly, preparing communities to cope with the risks of increased disasters, whether it be fires out west, rising sea levels, dangerous heat. They really require an investment in pre-disaster resiliency planning to the extent to the extent possible. Communities that have engaged in planning processes are better equipped to respond. And then in the obviously in the post-disaster context, a lot of very immediate cash assistance needs, but really, financing for the construction of housing that is not going to be in harm's way, that doesn't further carbon emissions, and ideally housing that is as far out of harm's way as possible. I mean, thinking about the 3 million Americans who lost their homes to natural disasters each year, and the fact that many of them are not going to be able to return. I mean, thinking about where we would like new construction, ideally denser housing close to public transportation, to continue to have lower carbon emission housing options for folks.
So thinking about resilient housing, I think one thing is some sort of best practices navigator. One of I guess the hurricane that hit Tampa, there was a story. Richard, you have Wake Forest roots, do you not? I think he's a Wake Forest football grad or something. Have built this community, this resilient community south of Tampa that was basically unaffected by the hurricane due to his building techniques and also to the energy efficiency of the subdivision. And so highlighting those and learning from those sorts of projects, I think, is a valuable role for the GSEs, and then also on the money side, incenting those sort of products. Mm-hmm. Like, is there a more favorable haircut for projects that incorporate best and latest practices in energy efficiency and weather resistance?
Adding to that, we know that there's lots of different forms of structural changes that are cost beneficial in the long term. We're talking about spending $1 to save $4, $6, $8 over the lifetime of a building, and we've seen this in studies again and again. The newest building codes we know can be incredibly effective in the face of storms, fires, you name it. The engineering technology is there. But even in places where the newest building codes are being aggressively adopted, there's so much existing housing that is older and not built to code, or not built to the newest codes. And even though investments in upgrading that infrastructure would save us collectively money in the long term, the upfront financing to make those investments doesn't exist. And oftentimes the insurance costs may not be adjusted in reflecting those investments that are made. So for example, with the National Flood Insurance Program, at least the pre-risk rating 2.0 version, so the way that the pricing works, it's not so flexible as to account for all of the different changes that a homeowner might make to protect their house. And I think that's true of fire risk as well. And so in terms of incentivizing those changes, thinking about ways that actors with more local and community scale knowledge can help bridge that gap between making the upfront financing possible and knowing that the cost savings are going to be there just in the long term, not immediately.
I think you were wise to divide it into two buckets that way, new construction versus what is already out there. The new construction piece should be easier to answer, should be driven by building codes and zoning. And certainly that can't all be left up to local government, particularly with the planning money. I do know that most of the states have got much better mapping that you would like to be led by the insurance industry. There's so many homeowners out there. Right now we're in this really weird inverse relationship. People who live in a red-line floodplain know that they have a problem, and they know they have to have insurance. But what we're seeing is more, because of global warming, we're seeing more and more storms that are affecting people who are way outside of those areas. and they have little or no coverage right now, and new construction is going on right there in the same way that it's already been going on. Hopefully, there are ways to address that. What you do with the housing stock and the development of the neighborhoods that we already have, boy, that's just such a mountain. I don't even know how you begin to climb it.
Yeah, I wanted to elaborate further on, the issue of folks who live in homes that were built before modern flood protection standards. As someone from the Northeast of the country, specifically spent a decade in New York City, where about 80% of the housing in the floodplain was constructed before the National Flood Insurance Program was created. And it's probably out of compliance, but the truth is that we haven't even really sent engineers to actually check out like the elevation and know just how much of a problem it is. These, individuals, there's a lot that folks can do, to protect their homes and their properties. Obviously, insurance, and I think insurance is going to be a theme that comes up quite a bit here. But, I think also, affordable, accessible financing for individuals to undertake improvements to their homes, such as storm drains, elevation of mechanicals, the most expensive part of a house, pretty much from the basement to higher floors, and things like that. And they need information. I would say housing counseling, since we have a very large network of housing counselors in the U.S. that understand a lot of the personal finance aspects. I mean, yes, right now I'm trained to deal with mortgage foreclosure, but a lot of these issues are really similar. And I think particularly with, at the individual level, having financing that is not exploitive, that has all of the robust consumer protection standards that we would expect. And I mentioned this specifically because, we've seen with the rollout of the PACE lending program, a lot of terrible incentives, where you allow contractors to originate financing that puts someone at risk of a tax lien foreclosure, when folks might not even be speaking the same language, might have limited English proficiency, might think that they're being, signing up for something that's free when they're not. There's obviously, I can get into the consumer protection issues later, but I think it's very important to be very thoughtful about the design of these programs before you start getting waves of folks who've been ripped off and who are, probably not going to trust these programs again.
So I'm going to move on to the next question, and we can continue to build on that very broad first question. So how and where can financial institutions engage in preparedness efforts? Let Stephen.
No, David, now.
Okay.
You all have
Great.
been going in order, and now we're breaking it up. I don't know.
Yeah, messing with you. This maybe goes back to the previous question more than the current one, but I think it fits. We did a report on climate resiliency and community financing last year, and one of the ideas we had was for the GSEs and the Federal Home Loan Banks to require energy efficiency appraisals, or to incent requirement of it, right? So to get to Richard's question about the mountain to climb for existing houses, every time that home sells is an opportunity to have that evaluated in terms of where it is, what could be done, and how that might affect a borrower's LTV. If it's more efficient, they are going to have lower heating and cooling costs, and that makes it more affordable. And so that's it.
So at a macro level, first, the financial institution, the bank or credit union, need to understand what is their risk portfolio, just like anything else. We've done a separate report, one on physical risks, one on transition risks, one on credit unions, and identified hundreds of billions of dollars that we believe are in the balance sheets today of banks that are being underreported. So first, understanding the risk, but then there are a range of issues from, I agree on the energy efficiency. One simple idea is to give an incentive if they've used the Energy Star program, an EPA program, or state-by-state energy audits, so that there's a discount there. Others to look at the capital reserves of the banks. and that I know very unpopular, but that if they are looking at these issues, the capital reserves might be a little less because their risk goes up. The other one is to encourage managed retreat. That, again, politically unpopular, I understand that, but the reality is, as Carolyn said, over 3 million people last year lost their homes, some temporarily, some long-term. The reality is not everyone's going to live everywhere we want in 2050. Is it better to do it in a managed or a long-term way? And then there's a whole plethora of insurance-related areas that financial institutions can support, from parametric insurance to microinsurance to others that happy to talk about later on.
Karen, can I jump in?
Yeah.
I think those are some topics that we definitely want to get into a little bit more in depth. And I had read some of your things that Sirius had submitted, raise those, so I think that'll be great. But Richard, let me, since you're wearing the banker hat today, you drew the straws to represent all bankers. No, but we're in this discussion about knowing the risks and the changes that you alluded to that we're all facing. I mean, just can you give us a sense of how it's impacting your bank today, climate issues? And
Sure, Chris, I'll be glad to try to do that. But I guess I've worn so many different hats in my life that may come into play here. I was the Secretary of Public Safety for the state of North Carolina, and in North Carolina, that person is the lead administrator under the Stafford Act, which created FEMA. And I led this state through 9 presidentially declared disasters. And in all of the work I did in that job, I'm just looking at the question, out of all the entities that I thought would come to play in trying to help our people, right? Because that's really what it boils down to when you drop all the phrases and the actors and how do you help your neighbor? I have to say, financial institutions were never on that list. We have in this country, and it's unparalleled in the world, access to efficient capital, whether to run a business, whether to pay for your home. We have more variety in that products. I keep up a lot with what's going on in Great Britain, and Great Britain doesn't have fixed mortgages. Everybody floats over there. How would you like for your mortgage to be floating right now, particularly if you were on a budget? Now that risk was offset by society and put onto the balance sheets of the banks by offering fixed rate mortgages. We knew when we were issuing those mortgages in the last couple of years at ridiculously low rates that those weren't going to look so good at our books someday, but it was a part of being an American and being a part of the community. So when I get to the role we play, it's providing the financing, and there are a lot of rules out there that we have to follow. I think we should have a lot of rules that we have to follow. I also think it's important for people to realize that the shadow banking industry, the financial institutions that are regulated, with every year that goes by, have a smaller slice of the pie, a ridiculously smaller in every single major category of lending. In this country today, shadow banks, non-regulated banks, have larger market share than regulated entities. So to continue to come back to the same group of people and say, well, help us fix this problem, help us fix that problem, I understand that's the way our government works, but I don't know if it's a good idea.
Thank you. All right, so again, what we're focused on here before break is around resilient building and preparedness. And we'll be diving into more of the recovery and in the next section. So let's talk a little bit now about what does the Federal Home Loan Bank system currently do? What's their current role that they're playing? And we can dive into that a little bit. So how do the Federal Home Loan Banks presently support preparedness and mitigation?
I'll just say, Karen, I didn't know they did. And that was one of the things that I was glad to be invited to participate here today and try to do a little homework. I understand there are some grant programs. I'm sure they're very worthwhile, but I didn't know that.
When it comes to this community investment program or the community investment cash advance program advances, Do you think that those are conducive to addressing climate resiliency?
Oh.
Oh, go ahead, Carol.
Yeah, sorry, I was a little confused. I mean, I think, you obviously have, I understand that there are some incentives within the currently existing programs, that give extra credit for sustainable buildings, and the disaster relief funding program, allowing members to assist with rebuilding and economic recovery in federally declared disaster areas. I think I'll return to my previous theme, which I might return to a few more times, is that, we simply need more of that. I think in looking, it seems like there's a pretty, the banks really vary by region of how much they're investing, and I think like if you, the Federal Home Bank of Atlanta, for example, seems to have a significantly lower amount of participation in these programs than, say, for example, the Federal Home Loan Bank of New York, where I'm located. And so I think to the extent that that there's, I think this is really where the FHFA plays a role with standards and a bit more uniform reporting, so that this information is accessible to the public, especially to the folks who are benefiting or not benefiting, depending on where they are in the country and what kind of services, products are available to them.
Thanks. Stephen?
David was before me.
Oh, go ahead, David.
So I think my understanding that SECA is very underutilized, and I don't know if that's just in Atlanta or across the system, but I think that they're, and I'm not sure all the reasons for that, if it's complexity, the products don't fit, or what, but I think that the bank boards need to be more aggressive in helping their staff figure out how to make SECA more usable, both in climate change and outside of climate change. And I think it's not really the purview of this discussion, but I think a lot of these sort of community development type issues get sort of shoved under the AHP, the Affordable Housing Program, too much, which is just 10% of, 10% grant program, was actually 30% when it first started, because 20% went to the Resolution Trust Corporation, I believe. But it's like, oh, well, maybe we can do that through AHP. It's like, no, we need to put more of the bank's balance sheets in play in being more aggressive, not just on climate change, but on affordable housing and a lot of issues.
Yeah, and I think, sorry.
So just very briefly, three things. One is what should be done at the local level versus one of the 11 versus national. If you think about some of the other agencies, whether it be Fannie or Freddie or Federal Reserve or FDIC, so I think there's more needs to be done nationally. Second is, I think that what David said, we'd recommend that 10% be increased for that. And third is, I think just follow up on your point, I agree, the banks are the foundation, and we're incredibly lucky for all the thousands of banks and credit unions doing an amazing job. And to address climate change, you look around the world, there is no country that is leading the risk protection where the financial institutions and the financial regulators are not leading, and the United States is behind. So we need to address this in a different way, building on the great work of the banks and credit unions have done for decades and decades.
And yeah, just to, I think the mixed amounts of uptake of these various programs, I think, are a sign either of, the regional needs are so different, but, or that there could be more guidance from FHFA and a bit more, comparisons in a way. Because if I have to download all 12 different, community lending programs just to know, like, what's happening, it seems like that might, there could be a bit more coordinated approach to informing the public about, what this system is doing and how, how it's using its resources and where.
Richard, did you want to get in here?
I think I'll pass.
You'll pass. Okay.
I'll add a different perspective, which is FEMA recently has had larger amounts of money to invest in communities doing preparedness projects. And one thing that they have been finding is that the hurdle for communities to apply is so large that the applicant pool that they get tends to be skewed towards bigger cities, wealthier communities with higher capacity at the local scale to even put together the application. And so when it comes to really expanding access, they have plenty of demand, lots and lots of communities that want to make these investments and do these projects. But when it comes to really supporting the full range of communities, they're really thinking about how to simplify that process and create new ways for smaller communities especially to navigate the administrative hurdles to even getting an application in for consideration.
No, and I think that gets a little bit to David's point about, the grant money ever being enough. But Richard, let me ask you, David made the point that the Home Loan Bank should be deploying that side of their balance sheet to community development, but I assume for purposes of this discussion, community development, economic development writ large to encompass climate resiliency or recovery. As a member, what's your reaction to that?
Well, I think that's great. I think what you always bump up against, and that's why I'm still trying to grapple what any of this has to do with the Federal Home Loan Bank Board, but I'm trying. If the way, as a member bank, the way I understand this is we are one of the owners of the home loan banks. And the reason we're one of the owners is because when we want to borrow money from them, we are required to be a shareholder. We have about, I think, a little less than 5% of the amount of money that we want to borrow we have to hold as a shareholder. And then we get a dividend off of that shareholder, just as most businesses that are growing and have enough money to have a dividend. But that dividend is very important. That dividend right now is about 9 basis points, that when we borrow the money, it's basically a rebate back at 9 basis points. So let's just say we want to borrow money for a year right now, and that's at 4%. We know the real rate of that is 391 basis points. We're going to get 9 back. If the board increases the amount of grant programs and other things that they are doing too significantly, don't get me wrong, I'm glad that there is a dedicated position, but you got to back the numbers out, because if that money gets too big, then all of a sudden the borrowing that we do doesn't look attractive. Right? If anything has changed the most since this system was created 90 years ago, which, by the way, I need to get this plug in. My grandfather, Frank Hancock, wrote this legislation when he was the only practical banker in the United States Congress during the Depression. This is a great small world story. Where on earth would I ever get a chance to talk about this again? And was actually on the Federal Home Loan Bank Board from 1939 to 42. And you guys even had me reading some law review article from 1939 from this, quoting him on the original purpose of all of this. But the thing that's changed the most is there wasn't anywhere near the liquidity in place then that there is now. If you make the borrowings, the advances, unattractive, we won't use the system. And if we don't use the system, it doesn't work at all, because even right now, there are other places when we need liquidity that we can go that sometimes is already more financially attractive than this scheme. And so I'm not saying we shouldn't do that. I'm not saying we shouldn't do more. I'm just saying that's a very realistic concern to put on the table, that this is not a bottomless well of money to try to do good things with. And don't get me wrong, this is all really good things that are trying to be done here.
Well, I'm excited to meet someone connected with the origin. This is fantastic. My question, just to be a little bit more precise, because I took what, and David, you can jump in here, but I took what he was saying was not so much the grant, was the opposite of the grant program. So it gets at, I think, what you were talking about, the borrowing, the advance rates, was actually making more of these types of quote-unquote investments through advance activity. Deploying the balance sheet in that way. Is that where you were?
Well, I think both. I think deploying that way, but also using some of the subsidy.
Sure. But I mean, in terms of to magnify the impact.
Yeah.
And so what I hear you saying, Richard, is that advance rates
you
matter.
take-
And
if
so,
you take too much out of the direct dividend back to the institution, we may just not use the system at all.
well, but what if we got a massive, not going to say massive, it's a loaded term. If you got a significant discount in your advance rates, would you do more activity?
Oh, sure, yeah.
Even at the
But
expense of
how do you-
dividends?
How do you,
right?
that's gotta pencil out. Somebody's gotta pay for that, right?
Well, but I guess for purposes of today's discussion, I was just like your reaction of if the advance rates were lower to finance some of this activity. I mean, how does that play for a member? I guess is the
It plays great as long as there's enough left to run the system. Yeah, that's.
okay. Fair enough. Sorry, I
Yeah, no, that works.
No,
That works
no,
for
that's
us.
fine.
That's just
Right.
got to come out of somebody's budget. That doesn't come out of the air. It comes from somewhere. But I'm fine with that.
Stephen?
Yeah, I first, congratulations on the legacy. That's really impressive and great to.
You're kind to use the word impressive. I don't know that it is anymore.
Did he have a cape? Did he know?
And I guess, just following up on what Karen said earlier, I think over the next decade or two, we as a nation are going to have to spend more on this. I mean, just take Florida. Last year, they spent $3 billion to protect their reinsurance market. They hadn't planned to do that because their reinsurers were leaving. Who knows what next year, the following year.
It's only going to be worse.
That's just an example. So we as a society will have to spend more generally. And then if we care, which we all do, of low wealth communities, there's a particular focus there. So if, for example, someone said, hey, for your bank, you have a lower rate if you meet these needs, or if you focus on climate, you might actually use it more then. So there could not just be a negative incentive, but a positive incentive.
Absolutely.
I was just going to talk about, I don't know if this fits right to this question, but to Richard's point about he oversaw 9 disasters in North Carolina. They're not one-offs anymore, right? And so, and I know we've tried to do this in North Carolina with not as much success as we'd like, but disaster preparedness is a full-time, like its own department now, and needs to be. And so I wonder to what extent the banks can help our members think more systematically about when the disaster hits. How does the bank react, to Richard's point? We, in eastern North Carolina, the various floods, Fran comes to mind, we deferred all loan payments during that period, and I'm sure some banks did the same, but is there some sort of way that the Federal Home Loan Banks can really help guide members when the situation hits?
Right, and after break, we'll get into more of the recovery aspect of the discussion, but in speaking about preparedness, so I've got another question here to keep the conversation going. When it comes to mitigation and preparedness, should there be different requirements or asks of Federal Home Loan Bank members depending on their membership type? For example, commercial banks, insurers, housing finance, state agencies, et cetera.
Well, if you take it back to the original purpose, and Congress has made some changes on membership, but I don't know that any major changes have been made. If the original purpose was to encourage liquidity to have more homes built, right, whether affordable, not affordable, and the other thing that was going on at the time, and we actually saw a little of this after 2009, 2010 in the country again, if you have too much of a boom and bust cycle in residential construction, when there's a bust, too many people go out of the business. And one of the reasons, my understanding of why the Federal Home Loan Bank Boards were started to begin with, was to make sure that was less of, to take the edges off both ends of the cycle. But in today's membership requirements, if you don't run a mortgage department, if you aren't trying to do affordable housing, if you aren't trying to make a direct play into vibrant communities by providing that financing, and there are all sorts of ways that you can be a member that you provide indirect financing, but I think you could make an argument that if you don't provide direct financing, that your membership access should be different. It should be steeper. It should be Steve, whether you want to, whether it's a positive incentive or disincentive, there should be a difference for those of us who are out there every day trying to get folks who can barely afford a house in a home. And it's rewarding work when it works.
So what would that look like?
Well, so everybody doesn't have completely equal access. And to my knowledge, that if you're either a member or you're not a member, and if you're a member, you can pledge different things to get the advances, but the rates for everybody are the same. So maybe it shouldn't look like that.
Yeah, I agree I agree with that. I think, I'm glad that we're talking about the purpose of the banks, and it's kind of thrilling to have a historical connection too, because, I think this was a pre-Fannie Mae attempt at incentivizing and providing liquidity to allow for housing construction. Now, if you look at the main activities of the bank, at least at the numerical level, it really seems to be providing, more attractive liquidity than other venues right now for banks, the largest banks in the country that do not do mortgage lending. And so, and then, I have the question, is that an acceptable public use? I mean, this is a public system. Well, it's, private public, but, most other sort of institutions that could fill this role would not have tax-free status, would not have privilege lien status over the FDIC. And in fact, the FDIC has, bailed out, I guess is one way of saying it, to the Federal Home Loan Banks to the tune of over $11 billion since 2006. So there is actually quite a bit of public money here and a public interest. And so thinking about how does this work for the public? I mean, right now I would say nearly the entire public, unless they have a particular connection, is not aware of what that the system exists in the first place, and I don't think that's healthy to have as part of the conversation, which is why again I'm very thrilled that we are having these opportunities. I think to the extent that we're asking things of members, for banks, you need to obviously have an acceptable CRA grade. There's not anything similar for the insurance industry. We don't have a CRA, for insurance, but we know that, and we'll get into this later, huge amounts of need there as well. And, and I think also, climate change, we're not, you said we weren't here to talk about the causes, but I think you do need to look at financial industry and insurance industry and the amount of investments in carbon emissions over the year, and that has to be kind of part of an understanding too. We all, we all have our own responsibilities here, but in the financial services in particular, it's going to be such an important part of our response to disasters and the non-disaster, sunny day flooding, that you're already seeing in coastal communities all over this country.
Stephen.
Yeah, three quick points. First is, I think there should be differential in rates, both positive and negative, and there's lots of opportunities there based on goals. Second is availability of money, that a large bank that has said, I don't want to be in the mortgage business, should they have access? Should they have less access? Those are, I think, significant questions, whether they have access. And then third is that there are the 6 largest banks in the country, and more are developing transition plans. They're all saying that there will be a growing risk in climate, and they've said by 2030, here's what they want their portfolio to be. So they're having banks, if they've gotten a certain amount of money, to have a climate transition plan. They each develop their own, but to require a transition plan as this is being required now around the world.
If I might just jump in on that, that is coming for all banks, but it's just not going to come through these entities. It's going to come from our primary regulators. So that is coming. They're already asking the questions. We are already designing our portfolios, who we lend to with climate concerns. So that doesn't have to come through this entity.
I agree, primarily Federal Reserve, FDIC, OCC, and they're starting with the banks, $100 billion or more, and then going to the, I agree. But I think the Federal Home Loan Banks can play a role in encouraging and information, technical assistance, and in motivation. I think there are a variety of things that they could do.
Yeah, I think the banks play, I mean, as Richard said, we've got regulators and for us, the National Credit Union, whatever, NCUA, missing my acronym.
Too many acronyms.
Too many acronyms. Thank you, bailing me out.
We can all agree on that.
But I think that the federal home loan banks have the ability to play more of an incentive role, right? I mean, with discounted, better haircuts, discounts, incentives to really think in a different way, whereas regulators are obviously much more the stick and keep you in line. And the other thing I think it's worth noting for a lot of these conversations that we're talking about at lunch is the bank members now make 30% of home mortgages, is what Chris, when I asked that question, you said roughly that. And so that means 70% are outside of the system. When the system originally, I'm sure at some point was 100% or close to it, you know. And so that's not necessarily a bad thing, but it's a reality that about what the bank controls, about where its mission goes, should it change or not, and just something to grapple with both in terms of climate and more broadly.
So beyond contributing to the AHP, what ways could the Federal Home Loan Bank system directly or through their members play this greater role? And what's prohibiting them from doing that? So, I mean, we talked a little bit about how you could augment the existing products, but what could be additional products or programs? Thoughts on that? Why you guys?
I was going to add something to what David.
Oh, go ahead. Go ahead.
I was just going to tie together these 2 points about incentivizing members to take on more energy efficient and climate resilient housing, and that serving the combination of the regulatory purpose plus the incentives from Federal Home Loan Bank. I think, one, the regulatory perspective is going to be really focused on avoiding worst case scenarios. It's not going to be about trying to capture the upside of early investments in efficient and resilient housing and housing that's affordable in safe places. And two, because the portfolios of the biggest banks are naturally geographically diversified, and that is less likely to be true of the smaller banks, and therefore their risks from a few bad hurricanes in 1 year are likely to be very different than the big banks in terms of the cumulative threat. I think there is a real rationale, both from a stability standpoint and desirability, to be more aggressive at those scales than necessarily just for the largest financial institutions.
Right. Thank you.
I think, Karen, and we briefly talked about it earlier, but the issue of one of the questions is what's done at the level of the 11 regional banks versus national, and what should be required. And from our perspective, more should be at a national level, whether it's through a greater centralized infrastructure or just as the Federal Reserve does, is they delegate, okay, Boston Reserve, you're going to handle this issue, and Atlanta, you're going to handle this issue for the system. So there are different ways to do it, but I think there should be more national standards.
A couple of things. One, I'm still smarting from the, looking at the worst case scenario remark, but I guess as someone who lives in the bottom half of the glass, I'll own that as a regulator. I don't want to be an apologist for the banks, but Caroline, you threw out the amount that the FDIC has paid for, presumably that's some measure of failed institution, what they paid in the case of failed institutions. I do think it should be noted that I have not seen data on the institutions that did not have to be bailed out because they got advances from the Home Loan Bank. So I don't want to, balance that out a little bit. But Karen, if you'll indulge me, one of your comments in the written homework that we assigned, you talked about new ways to finance risk mitigation measures. And since we're talking about mitigation, I was just curious if you could elaborate a little bit more about what you had in mind in those when you wrote that, because it sounded intriguing to me, just different, given your research on different types of structures and so forth.
Well, I do think this relates to what I said earlier. There are a lot of investments in buildings that we know are cost effective in the long term. And so if you think about energy efficiency as an analog, products that that essentially pay the upfront investment and then take a cut of the savings over time in the form of the reduced utility bills. Those products were able to really dramatically expand the scopes of buildings that would take on these energy efficiency retrofits. The risks to the owner were very little because it was a different institution providing the capital, but then they get a certain amount of savings from those investments, right? And the person who provided the investment also gets a cut on that over time, and that accrues. I think in theory, there is an argument for insurance to be part of that equation. If I make a big investment in putting a new roof that's extremely fire safe on my house, that in theory should reduce my insurance payments because I'm much less likely to have to make a big claim on my house. And I think currently, and so is there a case then for insurance to provide some of the upfront capital, right, to support those investments and then benefit from that over time? I think there have been some small pilot programs doing this. I think in North Carolina there was one with wind, you might know about this, wind-proof roofs, where they provided loans, or I think there was some investment in expanding the pool of people who could access that. But I think in some sense societally we're leaving money on the table with the huge number of homes that are not up to modern building codes and with what could be done. So that's one area where I think there's kind of known options for reducing risk that aren't being taken advantage of at the moment.
Okay, thanks. You seem to touch a nerve because I saw cards turn fast and furious on this side of the table. Caroline.
Thanks. Yeah, I mean, I think, so this is something I have direct experience with when, I was working in New York City at the Center for New York City Neighborhoods. We had a CDBG-DR housing counseling resiliency program, which at the time we thought might have been the first or somewhat unique in the country, because like the complete gap between what we are talking about here and what and how a typical person views their home, understands risks, understands what might be cost effective options for making their home safer. It's almost a total disconnect. And I already did put in a plug for housing counseling, but I think I think there is a huge role here for housing counselors because there's a lot of very sophisticated financial arrangements involved: insurance, the ability to save money, the need for financing that does not make things worse, which in the sad case of PACE and its initial implementation in California actually did. I think those are all issues at the very, the very basic level of your house, and what kind of roof do you have, what kind of boiler do you have, and is it in your basement? If it's in your basement, that means that your costs, in a flooding event are going to be, X plus a new boiler cost. It's a lot, and I think. Trying to take it back, from the personal housing, having incentives, having better mechanisms for pricing that, that encourage folks to make long-term cost-effective improvements, really bears bears the long-term, more positive outcomes when you do have disasters. And I know I'm talking about flood a lot, but many of these things can, relate to other natural disasters as well.
So FHFA and the Federal Home Loan Bank can also have enormous power as a convener to bring people together and to give incentives. So in the insurance industry, there are literally dozens of examples where they've played not just shifting the risk, but changing the risk. Whether you think about seatbelts, they weren't going to insure a car if there were no seatbelts. They didn't change the risk, they stopped it. To college dorms and drinking, what insurance policies they offer colleges if they do or do not have drinking policies. So they changed it. And just following up on your point, the California Insurance Commissioner has a database, it's on their website, of 400 insurance policies that have a positive impact on climate. They may not be driven that, may not be the reason. One that we all know about is if you drive less, your insurance goes down because there's less risk of an accident. We're also using less emissions. But there are examples of wind and solar and others where there are insurance products. So they're great pilots, but they haven't reached critical mass in the marketplace.
So I'm hearing that the insurance industry can have significant impact here. So as far as the nexus with the Federal Home Loan Bank system, the membership rule is based on the investment and the holding of mortgage assets. What would be the pros and cons of expanding that to the activities of an insurance company? Like providing hazard insurance.
Well, I think that's a variation on what we were talking about earlier, but in terms of the banking industry, it would be the same thing. If you're more directly tied to it, maybe you get preferential access somehow, maybe. That's a perfect example. And the best example that has reached critical mass of what you were talking about, if I understand it correctly, is solar energy. And I love the way you phrased that. The consumer gets a grant up front. It makes a system, it makes the payback on their solar system much shorter. And then the person providing the money gets a benefit. The person providing that money is us, United States taxpayer, but we're getting the benefit of hopefully a cleaner planet.
So I want to I think I'm not responding exactly on point because I don't know that answer, but I wanted to just talk a little bit about, the insurers setting standards that move policy. We've already, I think, Richard, you already discussed, banks are preparing for this, for climate change with their regulators. Insurers are as well. And I think, I think in the past, when, these really important societal decisions are made, with just by financial institutions, the result is not always one, that has the most, I would say, like just outcomes, and I'm thinking, thinking of the home loan banks and the history, the requiring for one thing that the home loan banks did a long time ago. So no one here has any, this is all, a long time ago, but requiring adoption of the HOLC appraisal schemes and redlining maps as a condition for Federal Home Loan Bank membership. Obviously not, Federal Home Loan Banks weren't the only ones doing this, but as a result, you have a lot of equity concerns here that I think really require a special look at. We know that the harms of climate change aren't felt equally. Obviously, geography is a big, has a lot to play, but we know that communities of color, lower moderate income communities face much greater climate vulnerability, higher housing and energy cost burdens, and worse public health outcomes due to decades of racist housing, lending, and siting, and I would add insurance policies. Obviously the legacy of redlining and cutting off communities from credit results in not only higher physical vulnerability of housing, but also higher levels of pollution, from fossil fuel infrastructure, highway construction, and other practices like that. So I think it's, it's not enough to, develop, to have like a response, led by like the state insurance industry, but also to ensure, to include equity and racial justice as part of this very big problem and this very, large conversation, because I think, that's really, this is a quasi-public system, and I think that's really where we need to weigh in.
Thank you. So we'll hear from David, and I have one more question before we turn it over to Chris to go through the recovery question.
I was just going to say this fits in terms of equity, but also more generally, there's $27 billion coming down from the EPA, the greenhouse gas funding initiative that they're going to release in the next 6-9 months. And we're looking at that, in terms of how do what sort of energy efficiency products can we ramp up? And how can the Federal Home Loan Bank, frankly, help on that, or the other GSEs? And so one of the housing sort of related ideas through our secondary market purchasing loan purchasing program, we've purchased over the years a couple of energy efficiency on-bill financing products, loans. So in Oregon, they have you pay to buy your energy efficiency appliance or solar panels or what as part of your utility bill, and that loan is then it gets paid at a very the good rate because it's part of an existing bill, right? And it's different than what was the one you were mentioning earlier, it doesn't require a lien on your house.
Oh, PACE
Yes,
financing.
yes, right.
No liens on anyone's house.
Yes.
That's a bad idea.
But I think this money is coming down, and it's going to be a way, hopefully, to get these energy efficiency solutions to lower income families. And so I think it's something for all of us to think about as the EPA is developing where that money is going, because the last thing it needs to go is to, frankly, the people like us who can sort of afford to put solar panels on their house already. It needs to get to the people who really need the subsidy to be more efficient.
And renters, we really do not have much, if of anything, of a way of assisting folks who don't own property with resilience, disaster recovery, et cetera. And renters are 30% of this country's population, and it is a massive, they are harmed, in different ways. They don't own property, but it is incredibly destabilizing, and there's a huge amount of need there as well.
All right, so are there other programs working well that could be a model for the Federal Home Loan Bank system?
Within the Federal Home Loan Banks or in other entities?
Other entities?
I mean,
Any type?
So there's a number of great pilots that Fannie and Freddie have that can be used, and I have a list which I sent, but I'm happy to follow up on some of those. There are also, just on the IRA that was just mentioned, in addition to the 27 or whatever the right number of billion is, EPA, there's $600 billion overall between tax credits and revenue, and that for the banks, it can be another opportunity. So the Federal Home Loan Bank can be, again, a convener. They can bring people together on some of those areas, and that this can be an enormous opportunity of growth for the banks, credit unions, and members, and they can be a convener on some of those.
But, I mean, that a little bit gets at Federal Home Loan Bank mission too, because one of the use of funds here is going to be loans for electric vehicles, right? Which is not something that really falls in the Federal Home Loan Bank's purview, but maybe it should. I mean, when we talk about community in the Federal Home Loan Bank's mission, community implies a lot of things, and arguably just about everything, and reducing emissions through better, more efficient vehicles certainly is a positive impact for the community. So just trying to help in some mission creep perhaps for the banks, but.
Well, that is the difficulty, right? That there are certain things you think want to, but at some point it becomes all for everything. And but it's a fair point. I take your point.
All right, should we move on to?
Well, I'm going to exert some moderator privilege as I had a lot of coffee, and I would think now's a good time to take a break.
Okay.
So we will, it's 2:08, so let's take a 20-minute break and come back at 2:28 for our tech guys, and then we'll be back by then. Thanks.
Thanks.
Okay, welcome back. Hope everyone's recharged. So as Karen was indicating, we were going to maybe take a little bit of a deeper dive onto some of the other topics we've discussed already after the break here. It's come up a number of times, disaster recovery. So maybe we'll start with a general question, just to recap. What do communities need when it comes to disaster recovery? And Miyuki, I'll pick on you just because I think you had mentioned more for disaster assistance in your remarks. So, just as setting the stage, what's encompassed in disaster recovery for that communities need?
Sure. I think the first thing for everyone to know and be aware of is that insurance is the fastest and the largest source of funding that will come to a household after a disaster event. There is a wide misconception that FEMA, the federal government, is going to show up and rebuild your house, and that does not in fact happen. On average, FEMA assistance to a household is something on the order of $5,000 after an event. It's capped at about $40,000, maybe less, whereas insurance payments average closer to $100,000 in their payouts post-event. They're faster. Some companies will give you an advance even before an event occurs. So in terms of disaster recovery, we know that insurance is really, really critical to that. It's also been shown that insurance coverage protects mortgages. For example, after Hurricane Harvey, there were many banks that had extended forbearance policies on mortgages, but even so, the homeowners that had flood insurance policies were much less likely to default than those who didn't. So for many, many reasons, insurance is really, really core to disaster recovery. And we know that many homeowners are underinsured if they're insured at all. And then there's a whole tranche of homeowners who are not insured at all, whether that's for flood insurance or for other aspects of disaster risk. So I think at the homeowner or the family, I should say, not just homeowners, but also renters, at the household scale, our current disaster recovery processes really rely on insurance as the first option, with some level of social safety net after that is often not as extensive as people might think, and takes a lot longer to access than people might think as well. At the community scale, I think there are also investments in community infrastructure, community healthcare centers, schools, that there are government systems, higher state and federal government systems to help support, but I think a lot of those also fall through the cracks. And so recovery, when we talk about that, is a years-long process, because it's not just about repairing a home and getting a family back into a house, but it's also about restoring all of these critical community functions that often aren't the very highest priority for individuals and households after an event, but are really critical to the social network and to the strength of that community overall.
Thanks, Stephen. And maybe I also ask you to, you used a phrase earlier on, managed retreat, so maybe if we could get into that too, but you obviously wanted to get in here first.
Sure. So just on that, the idea of, and there are some great pilots, including in North Carolina, that Richard was mentioning his work in a prior life, and there's other examples where the idea is we won't be able to live in every place where people live now. Just with climate, it's just not going to happen. So instead of a government program rebuilding the home over and over and over again at the same place, maybe to say either that if you're going to rebuild there, we'll pay you 80 cents on the dollar or some percentage, versus someplace else, 100%. Or that if you built it with stilts or built it with certain protections or wind protections. So to give incentives to move people over time, with particular emphasis on low-income folks. That's in terms of managed retreat. Very hard politically. I don't want to underestimate as for a city councilor or a mayor or somebody else, but we're going to have to do it because it's happening now anyway, one way or the other. Think back to what Carolyn said earlier, those 3 million people who lost their homes last year. But there are a variety of other approaches, and every element from the banker to the bank regulator to the federal government has a role to play. So for FEMA, I completely agree with what was just said. We need more money in there. They need to redo their maps So that today, as I think you said earlier, over half the people live in areas that are floodplains that are not according to the FEMA map, so update those, looking at the amount of money, or maybe you said that, sorry, I apologize. Looking at those things. On insurance, there's lots of things they could do, but a few examples, parametric insurance, and there are a few pilots that exist, where instead of the idea of, I'm going to be insured, I'm going to go to your home, check how much damage you have, then write you a check, and it is the fastest, but it's also slow, that and there are pilots now in New York and Puerto Rico and other places, that if you're in a certain geographic area, and if there's, for example, 2 inches of rain within 24 hours, you get $5,000 or $10,000, kind of a small grant. It doesn't solve everything, but if you have a home, you've lost something, and you get mold in your house, if it takes 3 weeks to get a check, that mold has grown, so the cost has grown. So looking at some of those. Micro-insurance ideas that, again, not instead of, but in addition. So parametric insurance, micro-insurance, group insurance, and there are examples of all of these that can all be helpful as, those are examples, but there's a lot of other things on the bank side. And the credit unions and small community banks that tend to loan close to their geographic area for business reasons, they're also statistically, as you said earlier, at a bigger financial risk. While the big banks, they have a bigger portfolio, but just statistically a greater portfolio if a natural disaster happened to hit their area.
Caroline.
Yeah, so I totally agree with everything said here. I think, yes, in the immediate aftermath of a disaster, getting assistance to folks the quickest way possible is essential. And I think, like having, something like a parametric flood policy where, everyone gets a certain amount. This is something that's being, piloted in the U.S. in New York City is, one very important, program structure, but also, cash assistance, having, if you have any assistance, for folks who will not be covered under FEMA disaster assistance, such as, maybe folks who are undocumented, who maybe missed a deadline, something like that, making sure that those folks don't fall through the cracks. But yeah, and before that, you need information. And I'll tell you, I live in Troy, New York, on the Hudson River, so there's a flood zone. I can't access a digitized map of the floodplain in the town that I live in the year 2023. I have to, it's really, that's unacceptable, frankly. One of the things that I have worked on in the past was an educational website called Flood Help NY with the Center for New York City Neighborhoods, where I used to work. And everyone, it was a really, you can type in your address and actually get a lot of information about your flood risk from from more of a sort of counseling, assisting the homeowner, property owner perspective. But people were like, this is great. Why can't you do it for the whole country? It's like, because we don't have this data for the whole country and we need it. It should be all of our flood maps should be digitized yesterday. And that we haven't is a bad thing. And finally, one more point. Absolutely, buyouts are an essential part of our response to disasters, to places that, where folks shouldn't live anymore. Who gets those buyouts? How does that happen? And ensuring, as Yuki had said earlier, sufficient resources for rural communities that might not have someone to write grants, or to write these proposals is essential. And then finally, somewhere for folks to go, right? If we're saying you shouldn't live here anymore, where is where's this housing that's going to be affordable to them, especially for low-income people? And that's why we really need a lot of dramatically expanded affordable housing in areas that are not disaster prone. Also, we need more affordable housing generally because we have a housing crisis.
Yeah, and then I'd like to come back to some of these and see what your thinking is, or our collective thinking on, what actually can the home loan banks do in these things. Certain things, digitizing the floodplain is probably not going to be their thing, but it does seem like there might be ways that they could at least convene people or whatever, but we can come back to that, but I want to get David in here. Yeah, just go.
Well, I was really, not to put Richard on the spot, but given his experience heading, I mean, the depth of your experience on disasters is pretty unparalleled, certainly, I think, on this panel. And so just curious from what you recall seeing in those 9 disasters that were just like the pressure points that you think banks or the Federal Home Loan Bank could address, or what were the real systemic errors, I guess, or shortcomings?
Yeah, David, I think I hit on it earlier, and you're not putting me on the spot. I don't think there is anything. The immediate need in recovery, the entire recovery process, once you find out that you and your family members are still breathing, what comes next is your house standing? And then what comes next is how much damage have I received and where am I going to get some money? And you need it, and you need it quickly for a lot of the reasons that everybody just said earlier. But how this entity that we're gathered here today to talk about how that plays into this, I'm at a loss. I mean, there's so many things that anybody can do indirectly, but does that raise to the highest in the pecking order of the core mission of the Federal Home Loan Bank boards? I'm glad it's not my job to make that decision.
Stephen.
So when we think back, and I don't want to try to pretend to be your grandfather in terms of the historical context, but from reading some of the articles, it was set up to
If you were, you've aged really well.
It's to meet a critical financial and social need in terms of home equity and home ownership back then. Well, today, as every financial regulator at the federal level has said, and around the world, is the climate is an empirical risk, not just to our society, but our financial institutions. Federal Reserve, FDIC, OCC, 82 central banks around the world have said this in one way or another. So I think part of that is we all have to play a role. What could the Federal Home Loan Banks do? There are 3 buckets of things, and I'm sure there's more. One is to encourage pilots. To try a variety of things and get information out there and get data. Actually, I'd say 4 pilots. Second is research, and maybe they do that with universities, they do it with the Federal Reserve and others about data out there. Third is looking at incentive rates for interest rates, as we talked before. Positive in some ways and maybe more restrictive in others to have the capital reflect those needs. And third or fourth would be convenings. To try to bring people together to incentivize that. So there's a combination there of, think about carrots and sticks, more on the carrot side, but I think they could do a combination of all of those.
Caroline, you looked like you were about to say something. So the convening thing is interesting, and obviously that's something that they would not be a heavy lift. It might be hard to get down specific sort of deliverables, so to speak. But some of the ideas you were talking about, if I understood earlier before the break, sort of a shared, the parts of the savings that you might get from some of these things would be captured and split in certain different ways. The parametric insurance, these things, they seem to call for a sort of a neutral third-party validator or something, right? I mean, how do you validate the amount of the savings? Or, maybe it's trivial with the case of rainfall, but I mean, is there a role for the bank system as sort of the imprimatur of a standard setter? Or I'm just off the side. It came up in response to some of the things you raised earlier. So I don't know, does that sound at all?
Sure. So I'll just take an example. In the last few years, and these are examples from the Federal Reserve, OCC, and FDIC in different ways, with the pandemic. They had, the entities had different rules, and particularly the Federal Reserve, things that they had never done before. They were part of their mandate, they'd never done before, to meet that need. And in the housing, if we start with the assumption that we are at a crisis point with housing, and more so because of climate and more so for people of underserved, then what FHFA and the Federal Home Loan Bank systems could do could, again, be an imprimatur. And if we look at that, the cost of capital, that's one where they could say, if you're going to loan under these criteria, then your basis points is X. If it's not, it's plus some other area. And the collecting of national data, because we don't have enough of this. And they could play a critical role in that. And just by having the data, in France, when there was more data of what the banks were loaning to, it reduced over 6 years loans in more risky areas, some of the fossil fuel, by 42%.
Yuki.
One other thing I want to add is I think the consumer awareness education gap is just gigantic. I mean, truly, I think hard to overstate how little people know what they're getting into when they're buying a house. I bought a house a few years ago in North Carolina. I asked my real estate agent about every question you could possibly imagine on flood risk. I was probably his most annoying client ever as it related to flood risk questions. And he was fantastic, but there were parts of my questioning where he clearly was uncertain on exactly how it worked and could I even get it because I wasn't in a floodplain, and you can get it if you're not in a floodplain, and all of these things. There isn't a ton of data on what people know, but some surveys, one survey in particular that I referred to a lot, it was less than 10% of homeowners knew that they were buying a floodplain home. So when you asked them later, did you know when you made an offer that you were buying a house in the floodplain, less than 10% of them said yes. And when they were asked if you had known and if you had known the cost of insurance, would you have done something differently? Like, would you have changed your offer or would you have not made an offer? Almost 70% of them said they would have. And so this is changing through other data sources. We have other non-federal government sources of information on climate risk, and I think there's a huge amount of effort going into making this information more publicly accessible. But in terms of what banks can do, I think there's both an educational role and also ensuring consumer protection in terms of the quality of the risk information that is being shared. So as other sources of information about climate risk come online, I think there's also a lot more threat to the consumers that they might be interacting with information with that they don't understand, that isn't really vetted, that may lead them to misleading understandings of what their underlying risk is. And so both in terms of making sure people know what they're getting into and also making sure the data that's being used is of high quality, I think there's a role there too.
Thanks, Caroline.
Yes, I completely agree about data and the need. I think, and I do think that I do think that there could be improvements on the how the activities of the FHLBs, and particularly some of the programs that we were talking today, can be reported across bank and across region. Some other suggestions from our friends at the National Fair Housing Alliance, to include demographic data of folks served as well. And I think, looking at some other sort of ways that we assess, the public assesses banks, the fact that the CRA is going to be updated, that will be, that will be a process by which we'll get a lot more, more information on banks generally, and it will also, impact the membership criteria kind of by default. And one of the things that we have been pushing for in the CRA is not just awarding good behavior, but downgrades for financing, carbon-intensive deals, and looking at harms caused by some of these, what are the kinds of activities that these financial institutions, including insurance companies, are financing. Obviously, we've said our piece on that, and we are awaiting, the final rule. But I think those are, that's another, another mechanism, another lever, for ensuring that, member banks are complying with, these obligations.
Okay, thanks. I do want to come back to one thing we were discussing a little earlier, but you stressed the importance of, buyouts as a in the toolkit. And I know that, the home loan banks in the event of disasters frequently do have a sort of toolkit that they employ, greater outreach, I think some interest rate forbearance or actions when an area is hit by a natural disaster, typically. But buyouts in terms of buying homeowners out of the property is something that potentially they might get involved in. But I'm curious as to how that. I take from your comments and some things you said at lunch. There's never enough money, and so in some sense the banks have that, but that there's an unsatisfactory process for who gets the money. How should this work, and how could this potentially work?
Actually, I think I might throw that question over to Miyuki because she informed me at the break that this is her area of special expertise.
How should anything happen is always a very hard question to answer. So we certainly know that there's a lot of demand for buyouts. So just so we're clear, a buyout is when the local government buys your property, tears down the structure, restores it to open space, and it's deed restricted so it can't be built on again. And I think that's the huge difference between a buyout by a local government and another entity is that that land is not going to be built on again. So it's very different from flipping, right? Because there are also there are instances of governments buying houses and then reselling the property for development. So we have seen many instances after disasters where the number of people who want to buy out exceeds the amount of money that's available to do it. Currently the process for getting a buyout requires, one, that your local government is willing to do it, and largely for, hypothesized largely for tax-based concerns, local governments are often hesitant about doing that because that means taking a property and restoring it to open space. It also means that your local government has to have the cost share, the local cost share for the federal grant. That's not always the case. And then finally, your property has to pass a bunch of eligibility requirements. So that involves a lot of documentation. You can't be underwater on your mortgage. Although, actually, speaking of pilot potentially good things, the New Jersey state program for doing buyouts apparently has negotiated with banks to buy out homes that are in various stages of not in compliance with their mortgage. And so they've gotten debt forgiven in instances and so forth. So that seems to be working. And then you have to ultimately get selected. It has to be cost beneficial. It has to pass all these requirements. And then you ultimately have to get funding from FEMA to do it. So we tend to see that high capacity local governments, they tend to be urban, they tend to be wealthier. These are the places that have the people who can navigate that application process. And then on the homeowner side, and this doesn't even get to the fact that renters are left out of this program entirely, people who kind of have certainly the linguistic savvy to navigate the bureaucratic system. They often have to be able to wait for years before the buyout goes through, so they have to have enough financial resources to manage that process as well. And they have to be able to afford somewhere to go once they sell that house. So that makes it just not an option for a lot of people who know that they live in a flood-prone place and would be interested in leaving if there was a real attractive option that they could move to. So I think in that sense, affordable housing is giving people real options. And I think without that piece, without the supply piece, it's very hard to even if we had the money, without supply, it would be really hard because where would those people go? They would have to move huge distances from their job, from their schools, from their social networks, and so forth. And so I think one piece of the puzzle is actually just expanding supply of affordable housing in safer places, because if you don't have that, the rest of the conversation is really hard to have. Expanding funding, I think, as I just mentioned, engaging financial institutions in this, I think should be part of it, because the government has decided that it would be better long-term for nobody to live in that property. And so the idea that you can engage a bank in that process, I think, is sensible. And then not having it be limited to right after a disaster, because that's often the hardest time for people to make these choices. So creating a system that's a little bit more, that's not quite so time dependent. All of that, I think, helps make it less stressful, more realistic, a conversation that doesn't feel like you're actually forcing someone out of their house, but really giving them options to think about how they want to live and where they want to live. So I agree that in the big picture, there are places that we are going to say that's not the wisest place for people to live, but how we navigate that process, it's all in the details of how we make that happen.
Yeah, and
Did she stall long enough? Thank you for that.
yeah, I mean, I think, yeah, I mean, anytime, just like in local, like just in like local school funding, anytime that you rely on local government, you're, kind of de facto creating an equitable situation where the wealthier, more well-resourced are going to be able to take advantage of the program, and, the rural, poorer communities, less so. And that's, frankly, a structural aspect of how we approach disaster recovery generally. If you look at who benefits the most, it tends to be wealthier and whiter folks, obviously homeowners, and who is in the worst position, renters, lower income people, people of color. Those, are the folks whose needs are not being met by our disaster recovery system. So I think there's, I think ultimately, we need to separate this long-term resiliency work, including, buyouts, from our disaster recovery framework, because that's really meant to be a one-time, time-limited, kind of episodic shot, and that's just not where we are in terms of where we need to be as a country, And so I think that is another, I know that the Federal Home Loan Bank, you're not, you can't, single-handedly drive all of this policy, but I think there are a lot, there's so much unmet need here, and there's a need for a lot of information and technical expertise as well, and I think that is something where there can be a role.
Yeah, it's very interesting. That's something definitely to think about. I don't want to understand. I mean, as Stephen said, the political issues, small p political issues, not least if a federal entity is perceived as moving poor people out of a region, even if it's there could be some challenges there. But David.
Well, I was thinking about what Steve said about encouraging pilots, and don't want to over-focus on the affordable housing program, but that is a place, I think, to encourage pilots. Using some of that grant money as a way to figure, are there on mortgage financing programs that work for homeowners, or to get to the rental housing, how do you encourage the competitive part of AHP to experiment with some really creative energy efficiency programs for rental properties. So I think just something to think about, getting outside the box a little bit on AHP, and not just and going beyond sort of the normal what we've been doing.
And first, it is complicated, clearly, and if it wasn't, it would have been figured out and people would have solved it already. So it's not suggesting it's going to, but if there's enough pilots in enough different areas, and we're gathering that information, learning from smart professors and others, and starting with the assumption, we can't do nothing. That is not a decision anymore. And I'll go back to the Florida example, or what's happening in California, and there are many, many other states. I was talking to the insurance commissioner recently in one of the states on the East Coast, where she said they had more risk to their houses from houses living by streams than they did by the coast. So it's not just a coastal issue as well. Never mind, there are 7 states now that are out west debating who's going to get water. And so in 2 states, they've literally stopped housing developments because there aren't enough. So there's too much water in one place, not enough, droughts. So it is really hard, but and that's why I said earlier, we all have to do it together. The Federal Home Loan Bank system alone can't do it, but they can play a critical role directly and through their leverage of the capital they're giving to the banks.
Well, thanks. I'm going to ask this question just because it's something that's it's probably the wrong question to ask, but when we talked about, I mean, at a high level, if I have we live in a world of scarcity, I have $1 as a policymaker, do I put it towards keeping people where they are and retrofitting, or do I know the answer is going to be yes but I'm just trying in terms of how do we think about that? Just curious. And if you don't want to answer, that's fine. We'll move on. But it's just in the course of the discussion. A lot of this is we need to keep people here, but we got to recognize we may have to move them out. And so if we're in both worlds, we need to be to a certain extent. But in terms of prioritizing that, how do we do that? Because we're not good at that in the government.
I mean, I think it's a matter of cost effectiveness. If you can make a place, more, if you can, harden up a place, right? Invest in that is a lot, invest in strengthening what's there is always going to be cheaper, than tearing down and building new elsewhere. And the truth is, most places won't be completely underwater. And we have, a lot of, I think it's just like there's so much, I think it really depends, which is not probably the best answer. It's a little bit different than both and, I guess. I think if it's cheaper, if you can make some investments and keep a place, safe, that is the most important. I think when it comes especially to buyouts, that's where, the human safety, which is, the most important thing, has to trump everything else. And so I think, you have to kind of look at, you have to look at first and foremost, the potential for harm to human life. And then from that point on, as long as, that's not the type of place that you're at, cost effectiveness and how can we save money, reserve money for the hardest, most, desperate cases while still giving, more resources for folks in, areas that aren't necessarily the worst off, but, worse than average, let's say.
And in the home loan bank world, when we say it depends, that's an endorsement of the regional nature of the home loan bank system. That's how No, thank you, Stephen.
Yeah, clearly, I think I don't want to speak about it. If somebody is literally homeless or they're literally bleeding, you solve the immediate problem, absolutely. But what's the solution? And you build in energy efficiency into those solutions or where they're moving to. I'll give you an example of, and this is an example not for the home loan bank, but talk about how systemic the problem is. Because there are less trees planted in low-income communities are 2.3 degrees warmer than wealthier neighbors. So you could literally be a few miles down the road and there is more asthma, more health issues. So if the community planted more trees, again, that's a long-term solution, then you would affect the health of everyone in that area. That's just an example of some of those. So it is an end, and we need more money. And the president, for example, put another $1 billion, I think it is, to FEMA. It's needed. There are many states. We are going to pay now or pay later, and I think about the next generation and all of our kids and grandkids.
Yuki.
I think my first reaction was that there's probably more sources of funding available to keep people in place than to actually restore land to permanent open space. So if I had that extra dollar, I would send it to the latter because there are just fewer options for doing that. I do think that we're certainly, if you look at the National Flood Insurance Program and the way that's being led, there's clearly an understanding within that operation that buying out homes and restoring to open space is for a good chunk of homes, and they're still going to be better than elevating. So for certain homes, I think for the most hazardous places, I think there probably is a sense that in the NFIP, they're trying to stop the bleeding by taking those properties off of their books, essentially. I don't think that's true most of the time. And so most of the time, I think if you can keep people in place and keep them safe, great, because most people would prefer not to move. Housing, removing housing, like housing and the climate resilience and affordable housing, I think are just, we're going to see clashes more often where the question is going to come up of should we build affordable housing in dangerous places if we have such a housing supply crunch? Is it still worth it to do in hazardous places? And then if you have affordable housing in extremely flood-prone places, is it worth it to buy out those homes and remove that housing from the supply? And so I just think those questions are going to come up again and again and again. So frankly, any dollar that you can spend building an affordable house in a safe place is probably the longest term, kind of most flexible way to try to address the problem.
Well, thank you for that. I'd like to maybe pivot a little bit to a slightly different perspective. We've been talking about what the home loan banks could do or should do, might do. But let's look at the home loan banks themselves, and how should the banks and the system address their own exposures to climate-related and natural disasters, in connection with their collateral or mortgage purchases. Does anyone have any thoughts on that? Because that's one thing that they need to do, is to sort of understand their own what risks they're taking currently is from a risk management perspective. Steve.
Yeah, so just as every bank needs to ask its customers where are they invested and what are the risks because of physical risk or transition risks, the federal home loan banks, the same thing to their customers, the banks, and to understand, and then through their customers. So to literally first do an assessment. What is their risk? And it's often referred to as kind of scope 3, their financed admissions, and then develop a plan. It's saying, okay, here's what our risk is today, and in 5 years from now, where do we want to be? And in 10 years, and 20 years. Never going to get to zero risk, but what should that risk be? Some they'll be able to control, some they're not going to be able to control. And so that plan will drive their new loan decisions. For example, if a bank comes in and they want to borrow money, or the bank's going to do 100 new gas stations versus 100 EV charging stations, well, what's going to be around in 20 years? And so understanding, again, ask the banks and through the banks, their customers, what their risks are, and then develop a transition plan.
Carolyn, I can't tell whether you were returning your card or it's kind of halfway. So
there, yeah. Obviously, we're all member banks are awaiting the climate supervisory principles, that from the federal banking regulators that we expect to be finalized, this year. And, we're obviously, waiting to see what those are. But, definitely even, I think to the extent that they're good, smaller banks, even those not classified as as the large banks, that hopefully will have, good principles. Obviously, climate risk officers. I know the Federal Home Loan Bank of New York has a climate risk officer, but I don't believe that that all of them do. But that's important for operating good climate risk management practices, integrating climate-specific considerations into the broader portfolio and balancing them with business needs. I think another risk that we've talked about quite a bit, and some of our comments to the regulators. And I say we, I would mean the green finance team, who knows a lot more about this than I do, at Americans for Financial Reform Education Fund. But we need to educate members on climate-related physical and transition risks, as well as climate-related and green financing opportunities in greenhouse gas and pollution reduction projects, as well as climate resilience projects. And then also, to the extent that as banks as banks analyze their risk and potentially withdraw from certain areas, keeping in mind the risks of violation of the Fair Housing Act, Fair Credit Act, Community Reinvestment Act, because we do know that, that there is a racial component to climate risk, and that, pulling out, in that way could lead to, outcomes that would violate those laws as well. So that's something, that we have really emphasized as part of climate supervision, those existing legal risks.
Miyuki.
Yeah, I think so. Climate change can widen inequality in a couple of different ways. It can through actual events and the unequal recovery process that happens. I think the potential. So I'm all for. I think every institution should know their climate risks, absolutely, and should factor that into decision making. At the same time, I worry a lot that strategic withdrawal of investments from certain places due to future risks or potential future risks introduces a lot of room for bad, inequitable outcomes. And so when we think about future risk and what might be most risky in 30, 50, 100 years, part of that is the climate. The other part of that is where we invest in adaptation. And so you can imagine that I get asked this all the time. I get asked, why are people still paying millions of dollars for waterfront condos in Miami? And one real possibility is that they believe that collectively the local, state, federal government is going to spend a lot of money to protect Miami, keep the risks low, and they're going to be fine in the long term. And so capital will keep flowing to those areas where we really expect, where people are optimistic about adaptation. There's a whole lot of places that aren't Miami, and people aren't going to be as optimistic about adaptation. And so if we withdraw capital from those places, which maybe have the hardest time accessing capital already, then they don't actually have the money to make the investments, the protective investments they need. Their risks actually do go up really quickly over time. And then it's almost a self-fulfilling prophecy where we've said, I don't think they're going to adapt, and then we take away the resources that they could have used to adapt. And so I really do think that basing decisions today on 2100 risks, where we control so much of that risk and how that evolves in the future in terms of where we invest in infrastructure, can introduce undesirable outcomes, and needs to be done really, really carefully.
Stephen.
I agree. Excellent point. Just quickly, and the regional home loan banks may be doing this now, but is there as Carolyn said, a climate person designated each one? And then are they meeting regularly with Fannie and Freddie and HUD and FEMA and the other agencies just to share information? That in our experience, there's been a lot of siloed information among different agencies. So that may be happening. I'm not aware of it. But if not, that would be very helpful to reduce those silos.
And there is, as part of the initiative at the agency, there are meetings occurring across our regulated entities, which include the enterprises and the home loan banks. David.
Yeah, just sort of what.
Not to say that there shouldn't be more effective ones, but anyway, sorry.
What Steve was saying, I think making sure it's done in concert with the regulators and the other GSEs, and Fannie and Freddie underwriting standards. How does that play? What the Federal Home Loan Bank, what sort of haircut on what types of loans the Federal Home Loan banks are going to buy, and so how do you coordinate all that? I think is critically important.
Caroline, did you want back in?
Oh yeah, I had just a very building on something that Miyuki said. I think these decisions that we make now, especially if we don't take into account equity concerns, can really have a huge impact. Let's talk about redlining. That is something that, formally as a practice ended decades ago, yet you can, still make incredibly strong correlations of redlining with a lot of childhood asthma hospitalizations, for example, lack of trees, all of the things that we don't want. And so, let that be, those impacts are still persisting, 2 generations later, I think, should give anyone pause in thinking about how we approach this and ensuring, that we take seriously, the principles of racial equity and ensuring that underserved people are served.
This is obviously an evolving area, and I know Karen, as Associate Director, has a portfolio of home loan banks that she's keeping tabs on what they're doing in terms of risk management and environmental risk. But Richard, recognizing that there's still guidance to be forthcoming, anticipated from the primary regulators and so forth, but presumably you're not waiting around for the government to tell you what to do. But I mean, I'm just curious, are these factors currently how are you managing? Are these discussions that you're having within your own institution about environmental risks and how to manage those on an emerging basis, or is this still early days for you? I'm just curious.
No, it's not early days at all. If you don't manage your risk, you're not in business anymore.
Right.
So this is the term enterprise risk. This is we're a for-profit company, and so anybody who is the interesting thing about the financial business is that our product is very unusual. And when I say that, most people who are in the sales business, the sale occurs once. If you're selling pants, you're selling sneakers, somebody comes in the store, they buy them, they're gone. I mean, they might come back, but they're gone. In our business, the sale is every day until the loan is retired, until it's paid back in full. And so I'm sure there's some people out there that if there was not a regulatory focus on this, might ignore it, but they should be fired from their job if they did. So yeah, we have a pretty large market share here in New Hanover County where we sit today. It's interesting how my bank got here. We took over the largest failed institution in the state of North Carolina that was headquartered here. We bought them in partnership with the FDIC 10 years ago. We're very cognizant of where we loan. We don't do any multifamily anywhere near the ocean. We don't do a lot of ocean close to anything housing. The point has been made, though, that the risk is just as high in other places that are nowhere near the ocean. And one of the great things about North Carolina is not in my lifetime will we ever be fighting with 10 other states over water, because any hill you go over, you run into another creek. We got plenty of water. So we spend a lot of time on this, but at the same time, our regulators are also encouraging us. We have to have a, we are so regulated, right? And don't get me wrong, what we get for that regulation is we get to go to ordinary Americans and we get to take deposits from them, and those deposits are insured by the federal government. So we should be regulated. But we have a new model that doesn't even come from our regulators. It comes from the accounting side of our regulators. We have to be, if you are a publicly traded company, you have to have external audits that are done by the SEC. Well, that doesn't have anything to do with financial regulators. We're like Ford Motor Company in that way. Well, in our external audits, when you do what we do for a living, we have something that's called CECL. Now, we're in the second or third year. We set aside our loan loss reserves. When we make a loan, we have to set aside the money up front. And environmental factors are in that program. And they're changing all the time. So they're being put in that way. But then, as I said earlier, our primary regulator is the Federal Reserve. And for 8 years, I chaired the State Banking Commission as part of being the former treasurer of the state. Through the traditional regulatory channels, we are being asked right now, it's not mandated, but how are you forecasting this risk? And that's not a conversation they're going to have to push very hard on for the reason I said earlier. we make loans and don't get paid back, we're out of business.
Thanks. All right, I'm going to turn it back over to Karen and talk about transition risk or whatever she wants to talk about.
Right, okay, doing a deeper dive into transition risk, building off a lot on what you were talking about. So how can the Federal Home Loan Bank system help promote alignment of financing and capital towards a future with lower greenhouse gas emissions?
Are you talking about building materials?
That, just the technologies as well?
Yeah. So, I mean, there are a variety of ways, but for example, there is low-carbon cement exists out there now. Half of and this is now for the federal government, half of the cement in the United States is paid for by the federal government, not just for housing, but for other things as well. So the federal home loan could offer a haircut in the rate if people used efficient building products in terms of wood, low-carbon steel, low-carbon cement. David talked earlier about the energy efficiency require or incentivize Energy Star program. So there are a variety of things, some that are out standards now, the green building standards and so that, again, some that are existing now, but they could go even further in terms of those materials. And the same on the area, looking at indigenous populations and protecting the berms and the other areas there. So there is a number of areas there. And in information, just in terms of smart homes, to build that in. So we're looking at that information. And where I live, I get something twice a year from my electric company, tells me my energy use on a per square foot basis compared to the community. So I know whether I'm more or less efficient, as an example.
All right. Maybe could you speak a little bit more about how that could be operationalized if you're talking about very specific information about different properties, how that could be operationalized going from the member understanding that to the Federal Home Loan Bank understanding that?
Well, I mean, so I'm not in the Federal Home Loan Bank, so I can't answer it at a technical operational. But generally, if the Federal Home Loan Bank said that they were going to, this is a little bit of a simplistic example, but for new construction, for low carbon cement or energy efficiency or a variety of things, that there's a slight discount on the rate, that there's first a lot of information sharing, publications, research, convening, so that all the member banks have that information. Because I agree that any bank that knows this would want to do it. There are probably a lot of small banks that aren't aware of all these details. So that if they could share that information and then offer that at a discount, and that could cover a variety of areas.
David?
Yeah, I was just going to follow up on the convenings part. I mean, I think that the banks do have a great opportunity. The Atlanta Bank did it on heirs property last fall, and I think that was really useful. But so you've got local bank members like Richards Bank, our credit union. We know how to make loans, right? Our loan officers go out and make loans, and they have certain tools in their tool buckets to make those loans with, including the Affordable Housing Program down payment assistance for low-income borrowers. They don't use those tools if they don't know about them or they're not efficient. Mm-hmm. And so to the extent that the bank can offer haircuts or whatever and incentives for energy efficient tools, that's one part. The other part is getting the word out there to the local bank members. And that's where I think the convenings and educational experience come in as really easy to overlook step. But I think the banks, they have that convening power and should really maximize it.
Caroline?
Yeah, and I mean, I think, in particular, training programs for green lending, particularly focused on smaller institutions, CDFIs, community lenders, and one example that, we've seen recently that we like as the Inclusive Center for Resiliency and Clean Energy's virtual solar lending professional training and certificate program, which is designed for individuals with more than a year of lending experience who work at community-based lending institutions. And it provides training in commercial and consumer solar lending. That's a program that already exists, but there's a lot of similar needs. Fannie Mae has their green financing business, for pilots. That might be another area, where we're already within the agency. I think just overall, technical assistance there's a huge range of supports, that can be undertaken there.
All right, this is another broad question, kind of building on a lot of the discussion here today. So should the Federal Home Loan Bank system's mission include providing capital and grants to support the adoption or the development of technologies needed to reduce greenhouse gas emissions, such as energy-saving technologies, clean energy technologies, or clean transportation?
Yes.
You got to bite on this.
No, I just think I just think if it chose to do so, it would be extremely inefficient.
How so? Just, can you elaborate?
Because it would be so far removed from the way the entity functions that while it might sound good on a piece of paper, it would have almost no effect. That's what I mean
The
by
entities
inefficient.
being the Federal Home Loan Banks?
Yes. I just don't, I cannot envision, while it's a laudable goal, I cannot envision what you would do that would have a meaningful impact on that specific question, on the elimination of greenhouse gases.
Can I just ask a question? For example, we talked earlier about positive or negative incentives. So if they said a loan that had a lower risk, lower greenhouse gas, slightly lower basis points, and one's the higher, slightly higher. There's a lot of nuance there.
Yeah, but Steve, I'm not disagreeing with any of this, but you give a haircut to everything, there's nothing left. And so what's more important? Is it affordable housing? Is it smart construction? Is it reduction of greenhouse gases? All of these things are really important. But this is a Federal Home Loan Bank we're talking about. I mean, it's not the EPA. You asked a question, I gave you an honest answer.
I appreciate that. Does anybody else want to bite on that one, or should I move to the next question? All right. How could the Federal Home Loan Bank's products and services be modified or expanded to serve that mission? So I think we're saying this would be challenging to do.
Well, I may be the only one saying it's challenging, and I understand that.
No, I mean, it would definitely be challenging. I mean, again, as I said earlier, if it was easy, it would have been done. But I don't believe by any means the Federal Home Loan Bank system is primarily, quote, responsible, but they are directing enormous sums of capital and will have an enormous impact on home ownership in the next 50 years in terms of what our country looks like, where people live, what kind of homes. And so that they can have positive and negative incentives. If they just did what Richard's bank does, what he just said, and again, I'm just using those as examples, that alone would be building climate into their decision-making.
I agree with that.
I mean, I think, I don't think, can the Federal Home Loan Banking system single-handedly end climate change? Absolutely not. Does every single financial institution need to do something? Absolutely yes. And I think, there are already a number of, programs that, can be used for disaster assistance, in the existing FHLB's existing kind of programs and tools. And I think expanding that is important.
I mean, I brought it up earlier. I think there are some things are easier to do than others. I think, requiring an energy efficiency appraisal. I mean, that's something that you get Fannie and Freddie to require, and then there's or something like that, or there's a haircut involved. I mean, I think there has to be, it's inherent on all of us and on the Federal Home Loan Bank to find more and FHFA to find ways to address climate change.
And Dave, that is actually a great example, and you pick the entities. If the sister agencies who are primarily responsible for deciding what goes into the secondary market, if they stepped up and made that a requirement of closing, that's a much more efficient than anything this entity could do.
Right.
And a good idea.
Right, and it feeds into this entity because y'all give better rates to loans that are conforming, right? Or
And your collateral's
Federal Home
safer.
Banks do.
Your
Yeah.
collateral's safer.
Yeah, so,
So we think beyond collateral haircuts, but collateral types. Does that inspire any thought or discussion?
Not for this question of greenhouse gases. I mean, I don't know that would be relevant either, in my opinion.
so when you say collateral types, what do you mean on different collateral types?
So considering what collateral types could be an option here to support funding of technology and shifting the economy away from adopting technology, allowed it to adopt technologies or otherwise start hacking away at this very big
So we talked earlier about eligibility.
evolution that needs to happen.
Sorry, I didn't interrupt you.
Oh, go ahead.
So we talked earlier about eligibility. So I don't know if that's types, but who gets to borrow it and what they're borrowing it for? Should it be some of the large banks that have essentially pulled out of the mortgage market? And if they didn't get it, would that you reallocate to other people? And then can there be a list like the insurance commissioners do of, as I say, there's 400 insurance products that have climate. Could there be a process there? And this might be something more that FHFA could do and make available to everyone else as part of that. I'm not sure if those would fit in.
All right. So this is another question around transition risk as well as just risk management for the institutions. So in addition to climate risk events, financial sectors are vulnerable to abrupt and unpredictable shocks from new business models that can capitalize on low carbon technologies and disrupt existing business models. So should the Federal Home Loan Bank system strive to insulate itself from these vulnerabilities, or should it play a role in helping to stabilize the financial sector as these events occur, such as providing funding to bolster solvency of a firm experiencing significant loan losses stemming from a business model disruption?
That was a long,
That was a
artfully
long one.
worded avoiding of Silvergate and Bitcoin, if I ever heard one.
The same thing.
I mean, should the Federal Home Loan Bank bail out institutions that are experiencing high stress due to technological advances? Is that sort of the question?
That would be another way to paraphrase it.
I would say no. I mean, I'm just trying to think so anyway, but I'm hard pressed to think of an exact situation, the bank doesn't really bail out they're not in the business of doing that, are they? They're in the business of collecting when banks go under.
I think, we talk about the collapse of cryptocurrency, and, the cyclical nature of this going back to Dutch tulips or whatever, there'll be another tulip or cryptocurrency. I don't think, to the extent that the FHLBs have a systemic role as a, lender of a last resort, which we did, see with, with Silvergate, I don't think that's a very good thing for a quasi-public banking system to be doing.
All right, should we do our final round robins?
Yeah, no, and I just, I feel for Karen because, as a safety and soundness examiner, she wants to testify here, but she's not allowed. When we were so close, I thought we were going to sing Kumbaya for a moment, and then it kind of fell apart. No, so we're just about we're not out of time, but we're near the end of the questions we had. So I do want to give you a chance after this next question to bring up anything that we haven't discussed. But we like to kind of go around again. As I said the other day at one of these events, we can't walk and chew gum that well. So let's just hypothetically assume we can only do one thing. What would be the one thing that you would have us do coming out of this in relation to the climate matters and other things we discussed today? So, Stephen, I know you have a long list of things that you've provided to us, but if we had to prioritize, what would be your number one on your list?
That's a very complicated question. So let me, if I can just take a step back on some of the earlier point and then answer your question. Sure. So first is, I agree with what was saying about the climate risk, transition risk, but orders of magnitude. The European Central Bank did an analysis of the transition risks of the banks in with the ECB, and then we took that same analysis and did it for the largest banks in the United States. If you just take the largest 26 banks in the United States using the same methodology that ECB, it's literally hundreds of billions of dollars a year potential. Hopefully it won't happen because of the transition risk. So the number there is very large. That doesn't mean that's all the Federal Home Loan Bank's responsibility, but it's just an order of magnitude of that. In terms of if there's one thing, I think it would be more information and more accountability at every level. So information at FHFA, the Federal Home Loan Bank, the regional, the banks, so that people have homeowner, renter information, and that there is a system of people to deal with. Like any problem, any business person has SMART goals, and they're putting people assigned to a certain task. So it's more information and then accountability to address those. I think that's kind of two, sorry.
It's all right, we'll let it in. Carolyn.
This is a very hard question. I think I would say, as part of the, reimagining, assessing, of the bank's purpose, I think having, expanding the amount of resources, from the system to assist with climate resiliency, disaster recovery, and all of the wonderful things that we've talked about today really should be an end. I'm really hoping that it will be one of the outcomes of this process.
Thanks. David?
Well, yeah, I think just to think more, it's exciting to think about what the bank could be in the future, right? I mean, it's been pretty standard and has lost some of the relevance, I think, given the number of banks outside or lenders outside the bank system that are using the bank now. But we talked about this, at lunch. What if it was called the Federal Community Loan Bank instead of the Federal Home Loan Bank, and was broadened its mission in that regard? And I mean, the wild idea I had driving down was like, what if the Federal Home Loan Banks got into providing ag credit for its members? Because right now, community banks and credit unions are sort of excluded from the GSE ag world, because ag's GSE pretty much is insular to its own members, right? So you've got a very unfair competitive advantage in that situation. So a bit off topic, but there's a lot of climate issues, obviously, in ag as well. So I'll just throw that out there.
All right. That's a complicated one, but it's certainly interesting. Miyuki.
I think if I had to say one thing, it would be explicitly incentivizing construction of affordable housing in safe places. I think there is a rationale to incentivize that for smaller financial institutions where their risk is less likely to be geographically diversified. I think it addresses a lot of the underlying drivers of climate risk and climate impacts, in addition to other societal problems that we have. And where pulling money away strategically from certain places, I think is a little, presents more concerns. Proactively trying to invest in places where we believe they're going to be safe and we can build energy efficient homes, dense neighborhoods, access to educational and economic opportunity, I think that is almost a safer approach than trying to strategically withdraw from certain places that we worry about being risky in the future.
Okay. Richard?
So I think I don't really think the original mission is changed that much. The banks have a very special charter. They have a special way to make money that is sanctioned and protected by the United States government. And it was a laudable mission to provide liquidity to ensure that there was a healthy housing market in this country 90 years ago. I think that while you could certainly, and the result of having the privilege of spending time with all of you this afternoon, that it's convinced me that maybe the definition of healthy has changed somewhat. What is a healthy housing market? It's still the same. We all want, our society benefits greatly from having as many people owning homes as possible, and they'd like for it to be a good investment, so they don't need to buy something that they can't sell or it's poorly made. But to just go back to try to simplify that mission, I think would be a smart thing to do.
Well, great. Well, I did promise that I would allow you to bring up anything that you'd still like to, and actually there's one thing I wanted to ask Caroline. In your written comments, you raised, in response to a question about whether structural change was necessary, you raised a point about executive compensation. So I did want to ask you what you meant by that.
Yeah, absolutely. So I'm not talking about the bank members.
We're not giving me hard. I'm one of the worst paid CEOs at a bank in America, so and somewhat proud of it. So go ahead.
Yes, I think obviously, the federal home loan banks. I think there's actually a few different inefficiencies with the system. Having I understand, the need to have regional expertise, but I think, I don't think you need to have, all of these banks, each with their own systems, their own IT systems, C-suites. I think that there could be some efficiencies made there that would free up more funding for the kind of things that we're talking about here. Executive compensation, it's not a private bank. I mean, it is and it isn't, but it's enough of it not that it should be public sector, in line with the salaries at the Fed and other agencies.
Okay, I appreciate you wading into that. So thank you. Anybody else have anything they want to bring up before we close? Any last thoughts? All right.
I'll just mention, there's a study in yesterday's New York Times that talks about real estate developers. And what it says is that out of there's 112,000 real estate development firms, 112,000. Less than 1,000 is owned by a Black or Hispanic owned. So can the system provide incentives, education, it's bully pulpit? I don't know enough, but that was a very sobering statistic just in terms of thinking about the inequities in our system.
Well, thanks. All right. Well, I do want to thank you all for participating. I will confess on a personal note that approaching this roundtable, Richard, my thoughts maybe kind of align with yours in the sense that I was thinking, the home loan banks is not really the bread and butter, isn't the first organization you think of about when you talk about climate risk. But I did learn a lot today, and I appreciate all of your comments, and in particular, the idea of convenings and different vectors of using their power of that and their reach in that regard, if nothing else, but to improve information flows and data and awareness. Is certainly low-hanging fruit to a certain extent, but could have longer reach. But then some of the other more broad far-reaching ideas you've discussed today have been very helpful. So thank you all today. A couple of panelists had to drop at the last minute, and I don't think we missed a beat, so shame on them. No. But thank you all for filling the gaps. I also want to give a big thank to our FHFA team. As I mentioned, this is 14. I think we're going to have 19. So we're on the home stretch. This initiative is sort of caught a lot more air than the system is used to things catching related to the home loan banks. But I think it's a good thing. There's been a lot of interest from a lot of different quarters, and this has been very helpful. So. But again, so thank you to the team. They've worked very hard on this and done a great job. So I do want to say, particularly for the folks on the web stream, please visit our website. This broadcast, as Karen mentioned, as well as the prior ones are there. We have information about the upcoming roundtables. I think next is Wednesday. We'll be in Puerto Rico talking about access to the system from there. And we've got some virtual roundtables next week and one on governance and structure in Boston this coming Monday. After that, we will be having a wrap-up listening session. Again, the junkies of this initiative, that's how we kicked it off with 3-day listening session. We'll be having a similar listening session for people so they'll have an opportunity to respond to things they may have heard at the roundtables and otherwise. And our website is currently open for submitting additional written comments that if people have thoughts they want to and specifics they want to provide us. So please encourage you to submit things for our consideration that we didn't get to discuss today or on any other topic. So with that, I will let everyone go, and thank you very much, and thank you to UNC Wilmington for hosting us. Thanks.
Thank you.
Thank you so much for facilitating, moderating.
Thank you.
Thanks very much.